All right, greetings traders. Sam here from TradeDevils.com and TradeDevils-Indicators.com. Today we are looking at the latest addition to our lineup of pro templates. This is the graphical order flow template. Now I have it in front of us here. This is a 40-tick range bar chart on the NQ. You should be able to see down here that I'm recording this, so it's about 1 o'clock here on November 24th, day before Thanksgiving. And I've disconnected from data because I find it can be a bit distracting as we're talking about the specifics of the template. So I ran it through about noon of today, and as I always do, I'm just using the most recent data. There's never any need to cherry pick anything. So actually a pretty nice day to demonstrate how this works. Now there's a lot going on here on this template that might appear at first glance. So a couple of things that are just very obvious, and what I'm going to do here through the course of this video here, we're going to look at what makes up the components of this, go into those specific parameters and show you the choices, options in terms of how you set it up, and then perhaps we'll finish with a look at a trading template where I might include a few more things that I would use or encourage you to consider using, if not from us, from other people or other vendors, and we'll wrap it there. So my intention here is to keep this video relatively short. I'll probably split it up between the details of the template itself, and then I'd say look for some training videos to follow in the very near term. So again, this is Wednesday the 24th. Here's the open, and a couple of things should just jump out at you right off the bat. Of course, there's a zigzag that we have on here that is tied to what you see underneath here. We're giving you several options in terms of how you define the zigs and the zags, if you will. This is an ATR based zigzag that I have on at the moment, which is my preference. So in addition to that, I should note here that I have, as I always do with any of the videos I record here, I have our initial balance indicator on just to frame up the day. So I can get open. Here's our IB low. Now as we push right here, this is early in the day, we'll see the IB high. Also I have the Trade Devils toolbar up here because I'm going to grab things from that as I work through the video. All right, let's start with just from the open. So as you can see in this initial swing, there's a couple of things happening. In addition to the obvious zigzag, you'll note that there's some arrows inside of the bars, as well as variations in the thickness of the outline of the bars, and each of those are telling us something different. Before we get into the specifics of what's behind the bar outline coloring or what's triggering the arrows, let's focus on this histogram down here, because that is part of the cornerstone of this. So as you'll see here in the initial swing down, we're getting a cumulative volume total. So this is just tallying up the total volume through the course of this downswing here. So it's as each bar progresses here, we ultimately get a cumulative total. Then we get the reversal here, and so of course right now we flip up. So we get a swing, we get a retracement, we get a lower high, we push down, now we get a lower low here. Now, a couple of things are happening right here. Well, of course, you'll notice that there's divergence between the initial swing and then the second swing that we get here. So this pattern, which is, as I will often describe this is all the market ever does, right? It's all it ever does is swing and retrace. Now, when we have a swing, now we don't know which side is going to break, right? It's particularly when you're coming off the open. We have a swing, we start the retrace, but we don't know that one side of this is going to break. That we do know, right? We don't know if it's going to be up here or if we're going to break on the lower. In this particular case, we break down here. So it gives us the opportunity to compare the volume in those two swings. Well, as you'll note right here, we end up with some volume divergence, which is noted here by this. You're seeing the continuation of it because we get a series of these signals. But if we had not had the same thing here, you would just have this isolated, this line drawn here and this line drawn here. But interestingly, we get a series of divergences before we get the pivot and the trend change. So we come down here, we can look here, there's a notation here in the wick of the bar. The actual bar is colored orange, but because there's other things going on there, you're only seeing it on the wick, which is part of the reason why we include the line above and below, so you're not going to miss the fact that there's divergence there. So a couple of things right off the bat. Of course, at this moment in time, you have the ingredients of a downtrend, right? We've got a swing, we've got a lower high and a lower low. Now it continues. Well, I suppose you'd call this a double top, but here, if you were considering taking a trade here on the long side, you would need to be very conscious of the fact that this is a bit of a counterpunch swing here. So we've got an established trend moving lower. We've got volume divergence. If you're taking that trade, you need to recognize that you're going counter to the initial trend. Now that's actually a pretty decent move. So let's assume you don't take the initial bar, but you take the break of that bar, and we'll just take it to we'll just go body to body. Well, there's 76 ticks right there. Right, 380 per contract, and you're going counter trend. So off of that divergence signal, the initial pop there is, I mean, decent. So yet here again, and this is, I'm going to emphasize this as I've done in much of our training. This is all the market ever does, right? It's just a series of swings and retracements. So when you simplify the market that way, I think it can be helpful than trying to decipher every little nuance, every little bit of noise that the market makes. So this ATR-based zigzag is really showing me how the market is moving, and duly noted here, we get a continuation of that trend. Now, the first sign that we might have something changing a little bit here is the fact that we get a double top. So actually, this is one tick higher, which I reference that because it'll influence what we see down here. But this is the first tell that perhaps this is because we're not just getting another lower high here to a lower low. Perhaps a tell. But let's not digress into that too much. Let's just stay on here. So as we swing back here, so let me take these off here. So as we push back down, we get a lower low. Now here's our double top. Now ultimately we get another lower low. And what you'll notice is that each one of those swings down, of course, right? We can see this clearly reflected. The sellers appear to be losing interest. If they were going to push it, so now at this moment in time, it's 9:48. You don't know that's the IB, right? So IB first 60 minutes. We don't know that that's the IB low. It ends up being the IB low, which is why you can't see up here. You can't see the IB high. It hasn't been established yet because it's not 10:30. But down at this pivot down here, I've had this series of lower lows, lower highs, this being the one exception. Now I get another divergence signal here. Now, that by itself ought to be of interest to you. Now, of course, you wouldn't know if you're sitting there. We've had a swing, and how would you know, right, that we weren't just going to do that? Well, you wouldn't know, but the tell is there based off the fact that if sellers were going to drive this lower, if we were going to get this here, and they were going to just continue to drive it lower and continue in this series of lower lows, lower highs, you'd expect the volume would reflect that, right? You'd see sellers piling in here, and that volume would be increasing. We get the exact opposite, right? So, I mean, this is a particularly good example because it's just showing you on each of these swings, it's getting less and lower and lower and lower. So ultimately, the bears run out of firepower here, and then we get this big upswing, right? And it's clearly reflected by the histogram below. But additionally here, now as we come off of this, and that's a monster move. Again, let's assume that you're not going to get the tick low, but let's use the first break of that high. We get up here. That's a 234 tick move, right? It's damn near a straight shot. Now you'll notice here we do get a little consolidation here, which is one of the advantages of range bars like this, in that as opposed to a time-based bar here, where I can identify the consolidation here. So as I see that, now it's not going to be reflected down here because I'm still in the middle of this swing, but I can spot it. So you'll notice here that I have no arrows or bar coloring. I'm just the market's pausing here for the potential. Or so you might anticipate here that bears would be looking to push this down to keep that trend lower, right? To break this low and just continue with the lower lows, lower highs, right? And continue, but they can't do it. So this is a bit of a tell here and a confirmation that likely the trend is changing. Now, we of course we have the benefit of seeing what came after it. But if you're over here at this moment in time, well, I mean, if you're right here on the edge, you're thinking that same thing. But now look below, right? Is that something you want to sell into? Well, for me, there would have to be more there, and this would be the most telling, which would be, I don't know if I get that. There we go. let's get that hot. If I had drawn this right as potential resistance, once we get there, now look what happens as we get there. Now let's get a little further. As we hit it, we'll look below, right? So the cumulative volume here would be a questionable area to be selling into. You don't have anything to work with other than the structure. Now, you might be using some other indicator, whatever you might be using here to help identify momentum. What we're using here is the delta, which you can see being reflected here. So I'm just going to have it carry on here. You see that being reflected by, well, we're using both delta and the volume. So the little arrows here are a reflection of the internal delta of that bar, and then the number of arrows, whether it's 1, 2, or 3, is a reflection of how far we move past 1, 2, or 3 standard deviations based on the delta. So let me pause here and explain this, because once we go into the parameters, this will be very evident here, but I visually want to show this to you. So as we get here, you'll notice that I've got green bars, right? So these are up closing bars, but I've got two bars back to back as we come into that structure where I've got green arrows on the inside. Now, what does that mean? Well, I'm going to use the volume down here just to demonstrate that. So visually, conceptually, you can follow along here. So let's assume this was delta and not volume, and I had 1, 2, and let me got to draw another one. Here, let me get another one here, and I had 3 standard deviations. So now this is volume reflected here, but behind the scenes we have an algorithm running here that's tracking the individual delta, and you can define whether you want it per bar, per tick, minute based. We'll look at that in a second. I currently have this set to a 60-second delta read. So as we're looking at the delta increase, 2 arrows means we've gone in my drawing is not to scale here, but 2 arrows would mean we'd gone past 2 standard deviations of the average of the delta over X number of bars. So again, we'll look at the details when we get into the indicator. So 2 standard deviations. Now we pause. Now the volume at that moment in time, you don't know that more volume is coming, but as you sit right here on the edge, I can see that the buyers are the aggressors here. So potential, if we break here, perhaps if nothing else, we're establishing that this is a significant low as we've now moved so far and broken that pattern of lower lows, lower highs. Well, it turns out what we end up getting here is the opposite, right? So we get this swing here, we get the retrace. And again, this is the way to visualize the market, right? So all it does is swing, retrace. Now, do we break this pivot or this pivot? Well, in this particular case, we break, so we get the conditions here for a trend change. We have this long extended swing where we've broken the prior structure here, right? And we've broken it with buyers being the aggressors here. Now you can see there's a little bit of a reaction. You can you might anticipate that sellers were trying to drive it down here because we were at an obvious place of structural resistance. They can't do it. Now there's one last little push here, and you'll note here, so this would actually be to scale, where we have 3 arrows pointing up. So I know that I'm at 3 standard deviations from the average of the delta over X period of time. Pretty aggressive, right? So at 3 standard deviations, well, certainly that's showing me considerable strength. But at 3 standard deviations, do we want to perhaps consider that perhaps we're getting a bit overextended? Maybe. Well, not necessarily, right? You could have 3, 3, 3, right? And a very strong trend. It can keep ripping, but it might be just a little bit of a tell to you to suggest, well, hey, let's heads up because that delta is getting pretty extreme here. Well, note the next bar is a down bar here, and we leave this nice tail on it here. So as we move lower, now I'm going to take this stuff off. There's no signal here yet because all we've done here is just established a new trend, and we've broken the structure. So swing, we retrace. Now, we get a second signal right here. That's that purple triangle here. Now, what's that telling me? Well, this is part of how we're trying to help you identify whether or not we're swinging this way. We're going to pause here. Now, are we going to carry on and keep going lower and continue on with the downtrend, or perhaps head higher where we get a higher high, higher low, higher high? Well, in this case, we get a swing, retrace. Now, at this point in time, let's get an arrow. If sellers were going to rush in here to drive us back down towards this low, you'd anticipate it would be reflected in the volume, but it's not. We don't see it. And in fact, as we start to move away, it fires this little purple triangle here to insinuate that this is a no interest long, as in sellers don't express interest in pushing it lower. And that's a reflection of what's happening down here in the volume. Again, if they wanted to push it down to go after this, you'd anticipate it being reflected in more sell volume and driving the price lower. We don't. So this is a no interest long. Now we go from that right into the next pivot, which is the mirror reflection of what we have down here. We have a swing, we have a retrace, we have another swing, but the volume is not as high. Now it's not as long, but it's also just an obvious point of divergence in the volume. So you get the divergence signal here reflected by the orange line right in the orange wick. So as that reacts to that, now just like here, you're going counter trend, right? So this is a counter punching approach to it. I get the reaction. Now you will note here that I get 3 standard deviations on the push here. So buyers are aggressive here. You can see again, the market will respond to anything it can. So we've got the pre-market mid, and that's the what is that? I think that's the IB mid, right? So I've got this little structure here that the market is wrestling with. So I get a reaction here. Now again, it's not a home run trade, right? But that's more than you think, right? I mean, this is a 40 range bar. So what have I got down there? There's 79 ticks, right? I mean, so if every bar is 40 ticks, right, a move like that is meaningful. Now the signal is not going to fire until we get far enough away from this, and you can set that if you like. You can do it based off of the ATR, or if you're using a zigzag that's based off of a number of ticks or percentage. We're giving you the ability to define when that signal is confirmed. But additionally, right, obviously you're gonna see it happening. So do you want to be a seller here? Well, that's what you're asking yourself, right? Do I want to be a seller here? Well, again, that's 79 ticks. That's not a bad little trade off of that divergence, but we don't get a trend change here. What we get is just a continuation of the trend. So I get a higher low relative to the last swing, which creates the purple triangle because that's a reflection of a no interest long, right? Again, it's simple conceptually, right? I don't want to belabor the point, but if sellers were going to drive us down lower, to break this low, you would see it reflected in the volume, but they don't, right? They can't. Bulls overwhelm. So I get 3 bars in a row here. No outline change, nothing internal. Right, it's not until I break right here where you'll notice that the outline of the candle goes to a bright green. And now that's a volume, that's a reflection of volume, which we'll look at in a second when we go into the parameters here. But that's implying to me buying strength, right? The volume is increasing. Again, we'll look at that specifically. But now I get to the next bar here where I've got 2 internal arrows firing, which is a reflection of the fact that I'm at 2 standard deviations from the average of the delta over the X period of time. Now, so I get here, I've got another 2. Now, as I get back to the open, and that's the opening range high, I get a little reaction. Now, I see there's a green line here and there's a green line here. Now, what we're doing there is you had them throughout the course of this. Now, let me bring over a footprint chart to show you what we're trying to represent here. Much of what we're trying to do in this template is give you all of the benefits of a footprint chart without you having to try and analyze what's happening intra-bar via the content of each individual table of prices, if you will, within the bar. So we want to give you some of that insight here that you see reflected by, well, let's pop this open so you can see this. I can make the point here. So let me get back to the open, which is right here, I think. Yes, right here. Okay, so let me show that to you. So here's the open. Again, we don't have the initial balance set yet, so we just have the initial open, and this would be the opening range high. Now, as we're moving down here, you start to see that a couple of things are happening here in the footprint chart. So one, on the left-hand side of the table here, I've got a lot of imbalances. So the the purple magenta-ish coloring here implies that I've got delta imbalances within that bar. Because I've got multiple, it puts an outline around that bar. I've also got a negative delta. So not to digress too much into how to read a footprint chart, but there are benefits certainly here, but not everybody likes to trade this way or be down here trying to read into the tea leaves of what these are telling you. Right? So the other thing that you lose with a footprint chart is that you lose the ability to really kind of condense the chart and get a bigger picture visualization. So for those of us that are much more used to working with a traditional candlestick chart or bar chart, there's a bit of a trade-off. Now, ideally, you'd have both, right? That would be ideal, but if you don't necessarily need both here, and that's what we're trying to do with this template again, is to give you the benefits here. So what you'll see down here at the low, let's use this as a decent example, where you see the bar, the stripe here, and then the stripe here in green, those are a series of stacked imbalances as they're referred to. So I have three imbalances at the low here, which are noteworthy. So thus we make note of it. So as we come down here, what that's ultimately suggesting here is that I've got a bunch of sellers that went hard, that were aggressively pushing for the new lows here. They get it, but then it quickly reverses. So you have the potential for these to be trapped shorts, right? As the market pushes away from them because they were aggressive at the low. We can anticipate that as the market pushes away from them that they're going to need to cover. That's buy volume. Those are buy stops being triggered. Now new longs pile in, and then we get to right here where we have stacked imbalances within this bar here. You can see there's a 3 and then it pushes across, so we can identify that. So now how would that relate back to our template, right? So I'm trying to show you that we're giving you the benefit of that insight without having to stare at a footprint chart. So here as we open, so here on the way down, so here's that imbalance at the low. Let's see if I bring this over here, if you can see that. So here's that imbalance at the low right here being reflected right here. Now as we push up, maybe I'm making that more difficult, but as we push up here, here's the imbalances within the bar at the high. Here's imbalances at the low. So I can see that. So this would tell me, if I'm trading this, hey, there's a reasonable probability here that I've got trapped shorts as the market pushes away from them. Here is strength, so that on this little pullback that might attract you to trying to push for more upside there. Ultimately, we get up here and we roll over. Again, you'll note there's 4 red bars in a row. Nothing enhanced on the outline and no internal arrows. It's not until we get here that the delta goes 2 standard deviations beyond the average. We stall here. We get this little pause here in the market. You'll see that the outline here is red. Now you can fatten that up to whatever you like. I'm used to this. I think that's a 4-point outline. So I know that sell volume is coming in here and we're pushing lower. Now as I get to the bottom, I've got a red outline, but I've got 2 bars pushing higher. So there's a big thrust of buyers coming in here being aggressive. 2 standard deviations, 2 standard deviations, 3 standard deviations. Now note here, the outline is red as we hit the stacked imbalances that were in this bar, in this candle. Well, so that's why likely you would ascertain that that's why some sell volume is trying to come in here in response. This very well could be the people that were short here trying to defend to push it lower, but they get next bar is 3 standard deviations. So just prior to that 3 standard deviations, this push, now we get a no interest short here. So if longs were going to be aggressive here, it would be reflected in the volume. They can't do it. They can't change the trend. So what do we get? Well, we get a break to new lows, and we get the signal here firing, i.e. no interest short. Right, take it short. Now here we don't get the same for a couple of things. One, I'm 1 or 2. I think I'm 2 ticks higher here than this. I may only be 1 or 2 ticks higher here. So as a result here, I don't get divergence, right? And you can just see it reflected here. This is a little bit higher. The cumulative volume for this swing is higher than this swing. So there's no divergence signal here. Additionally, because it's higher than the prior swing, there's not a no interest short firing. There is a green candle outline here, so bulls were looking to take that. Immediately next bar, look at the aggression of delta as sellers come in and take it down. At the very bottom, which is often where you'll find these. I'm outside of 3 standard deviations on the delta. I get my pivot, and then I got my divergence, and then boom, 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 going the other direction. So if you were wondering here, do I have a good low? Because of course we don't know, right? We never know. Am I just going to do this and then head lower? As this is happening, that's very encouraging. Now we hit up a moment here when we talked about this just a minute ago, where we just consolidate, right? There's no delta arrows. There's no outlines here. The market is just pausing in the midst of this upswing. And it could be a reflection if you pulled this across. Could be you're just bumping into some prior structure here, right? We all kind of face that, going, can they get through? Can they get through? Well, next bar, right? Just continuation. Boom, 2 standard deviations, 2 standard deviations, 3 standard deviations. Next bar is an up bar. Down we go. No interest long. 2 standard deviations. Here's a fight to try and break it lower, right? The sellers step in, right? Do you want to sell into that? Not yet, because we don't have divergence. Now, here again, at the pivot, note we're at 3 standard deviations. There's the divergence. Right, so that's something to look for, which is why we did it that way. So visually, you could be clear. Hey, if I'm 3 standard deviations, that's mighty aggressive amongst the buyers, and perhaps that's unsustainable. Not always, but again, here it is reflected again. Here's a push. You can see here, this is a pretty good example here. So we leave this tail up here, so we've got this potential reversal happening here. Sellers come in aggressively here, trying to push it down, i.e. the aggressive sellers being reflected by the three standard deviations from the delta's average. What do they run into? The stacked buyers. The stacked imbalance that's in this bar. They run right into it, take it back up. Now, again, we're back to 3 standard deviations, and you'll find that will often be an area to pay attention for a possible reversal. Just that, a possible reversal. We could have another bar with 3 standard deviations. They don't go any higher than 3 standard deviations, so that's a bit of a heads up. Now, the market kind of pauses here. Again, no arrows, no outlines. We just pause, right? The market has to decide, what are we doing here? Right, what do we start to see below? Right, a little bit of a loss of that cumulative total as the market starts to turn. Now it accelerates as we go down. Now on our way down, 2 standard deviations, 2 standard deviations, 3, potential reversal bar here. What's the next bar? Right, not only do I get stacked imbalances within that bar, but then I'm 2 standard deviations, 3 standard deviations. Now here, this is also an interesting example. Again, I'm just using the most recent day. I got buy imbalances all within this entire section. Now, note here, because I think this is significant to traders. Let me clean this up here. We get to this section here where I have sell imbalances, buy imbalances, but in general here, the market is consolidating. We've had the big swing down, the big swing up. Now we're in consolidation. Now that's reflected below, right? Note what you see down here, right? Who's really winning here? Market that we don't quite know. Now it's, we're not too far into the day. It's 10:15 to 10:20. The market is pausing here. Now we're pausing right here. That's the pre-market mid and the IB mid. So we're pausing here before the market decides, are we going back down? Are we going up? Well, as we come out of that, what's the first thing you see, right? So you wouldn't know. They may not have been able to sustain it, but boom, delta aggression. Right, buyers are aggressive here to 3 standard deviations as they hit the opening range high. If they're going to get through that, they need to be aggressive. 2 standard deviations, 3 standard deviations, then again we pause. Right, this is well, you'd see the same. You lose this in a time-based bar here, so a tick or a range or even a Renko bar. So you're just going to pause here. Now, how do we come out of the pause? 2 arrows, right? Delta aggression. Come up to what so here's 1030, here's 1031. So we established the IB high. I think actually it's right here, right? So this establishes the IB high. Now this is a trade that we pay attention to every day. If you're not aware of this, I would strongly encourage you to go watch our initial balance video. And if you're not using the initial balance, you need to watch that video here. This is often, I would tell you, this is the easiest trade of the day in well, certainly all the markets that we follow. It's something to pay attention to. It's the first test of the initial balance high. First test of the IB high, first test of the IB low is something to pay attention to. We've been tracking this for years, and there's no question that there's an algorithm that sits there that fades it on the first test. Now, of course, there are days where it's going to blow through, right? There are news-driven days, the market's trending. You won't find, it's not 100%, but you'll find that if you took 25 days and you track that, I think you'd like the results when you see it. And here's just a perfect reflection. So here, as we get up here, look, here's the effort. So we've established the IB. Here's the initial little swing comes off of it. So here's the reaction trade. Now note that reaction is happening in the midst of green outlines. So the buy volume was pushing here to take it higher. What do I get off after? So I come back. Oh, maybe I can just do it this way. I come back to this little area of congestion here where I have no clear signs of aggression from buyers or sellers. We're just waffling sideways. We come right back to this level, the prior delta aggression here, and we get a no interest long. Next bar, 3 standard deviations on the delta, and they can't push it. Right? You would think, I mean, that would have been a clear sign if you were thinking about a long, which this would be I would tell you is not a great place for it if you go back and watch some of that content, or if you're someone who knows this trade. You might be thinking, oh, hey, man, look at all the aggression here at the IB. They're going to break it up, and we're going to have a big uptrend day. What do we get next bar? Right. So again, note it's 3 standard deviations. Next bar, no interest short. Now again, it doesn't look like much. Doesn't look like much. There's 62 ticks. Right back. Here. Now, this is also another good example here. So let me be sure you're clear on this. You'll note here that we get another push, right? So we get, after this, we get a no interest short at the pivot, right? So that's what we see here is after this massive upswing here, we get this little pop up here, and then just this baby little, just 2 bars of up volume here, volume that takes us up because this is an upswing, and then I get a no interest short. Again, obviously, after 3 standard deviations, they were trying to push it. They get rejected. Now we go again. They're trying to push again. You'll note 2 standard deviations, 3 standard deviations, 2 standard deviations. There's the pre-market high. Well, now what do we see down here? I should probably do it this way. Now, visually, we can see the divergence. So why no signal like we've had at all the others? Because the divergence signal, as it's coded into the software, is always a reflection of the last 2 swings. So since I have a little tiny swing here, the software is looking at this swing and comparing it to this swing. So because of that, there's no divergence signal being fired by the software. But us as traders, obviously, we can look at that and say, okay, I can understand why, because there's this short little upthrust here. So, but I can see the divergence. So it's not like, if you're trading this, you're waiting for one of these to fire. I mean, obviously you can see what happens here. Right? So that's clear signal to be. If you're not shorting the market, you're certainly paying attention, right? So it would be the kind of thing, if you saw that, if you were long, anticipating a break beyond the IB high, you might reconsider that, tighten your stop. Perhaps you get out of the market. That's to the individual trader's choice as to whether or not they want to sustain here. But look at the next bar here. I've got three white candles. Here's just how I've chosen to color code them. You color these however you like. I've got 3 white bars. So sellers are plowing in here aggressively to try and to the reaction up here at the IB high. Then I got 2 standard deviations. I come down here. Now, there's no signal here because it's at this pivot relative to this pivot here, I've got a lower low here in the volume. So there's no divergence here. And because it's a lower low, there's not a no interest long here either. So it's important that you understand the way the purple triangle works and the orange line works, right? They're essentially telling you similar things, but it's relative to a different position within the swing structure. So as I get up here now, same kind of thing here. I get a pivot here. There's nothing marking this, right? There's no divergence because I've got a new low in the volume. I've got a new low in the price. But and this is what is harder to do with a footprint chart. If I were looking at that thinking, is there some reason why we would be stalling here? Well, other than the obvious, right? The opening range was right there. Well, so there's a little bit of just structure you might be paying attention to. prior resistance, coming back here to test it. Now as I come to it here, I don't have any clear sign of divergence or no interest long, so this becomes a trade. Well, certainly there's enough to be looking here just based off of the structure. Again, putting this all back together and kind of looking here. Even if I brought this over, this would be an area that I would describe as an area of interest. Right now, you might additionally put a fib on this. Oh, looks like that's going to be pretty close here. So we're coming right to a 50, in between a 50 and a golden zone. Then we go up to target here. So there's other reasons why you might be looking there. But this is actually a fairly decent example. If you had drawn that up and you were thinking to yourself, hey, that looks like area that the market has responded to. Pay attention here. I'm going to come down and get between just a wick past the 50, knowing that's an area where algorithms respond. So that might be something that you would be considering. Now, if I'm looking at the chart here from this distance, I can see right off the bat here where I can get this bigger picture, which is very hard to do, right? When you're on a footprint chart, I can't. When I scrunch them all up like that, I lose this definition, right? That's the trade-off you make. This is a 4K monitor. I think it's a 28-inch monitor. I still can't see it all. Let me put this back. So here's the benefit here where I can get the traditional visual benefit of a candlestick chart and the support and resistance that are often made clear by that, but then I get the benefit of looking inside the candle without having to read the table of the bid-ask within that bar. I can see the buyers were aggressive. Now, as I start, well, you don't know at that time. I'm just be seeing this. So you wouldn't know, of course you wouldn't know at that time whether or not you were just going to maybe carry on. So I've got a swing, I get a lower high. I get a swing, I get a lower low. So how would you know that we weren't just going to continue down like that? Here, I'm kind of running out of room. Let me pull that off. How would you know that you weren't going to get that? Right? That we weren't going to, here, we'll do it like that. So you got a swing, retrace, and that we were just going to head down lower. Well, of course, you don't know. Right, looking down below, you certainly would have some evidence here that would suggest that perhaps the timing there, you would need more. Now, so it might be that there's a fib on the other side of that, right? So you might be looking here, and you'd say, hey, I came right to the golden zone. I'm anticipating that that's now gonna move lower. Well, you get the reaction off of the golden zone, right? We can see that. But now looking below, and again, this could be a function of maybe a few other things that you're looking at here. Might be some volume profile, might be a momentum oscillator here. Again, we'll look at what I use for that. But I can see here that the fact that I don't get any kind of decline in volume, I don't get any, sellers don't get enough traction here while there's an attempt. You can literally see the attempt as they pivot here and then go into the dark red outline here, implying the sell volume is coming in. It's short-lived. It's not enough to overturn the cumulative total here as the market rallies past it. So with the break right here, you know you've broken that algo. So now we get one green candle. So all I know is I've got an up close. That's all I know from that. I know the volume is continuing to accumulate. I get a double and then a triple, right? 3 standard deviations. And within that 3 standard deviation bar, I get a stacked imbalance. And this is often another way to use these in that the market, if it pushes, it will often come back to retest, right? And that retest being, you could tie it into all that. So here's but really on a bar by bar basis, you're looking at the retest of the stacked imbalances. Now, are we going? I'm not sure. 2 standard deviations, right? Delta, aggression. Now here, interesting, I've got red outline, meaning sellers are coming into the market, but the delta is still aggressive, so buyers still in control. Or at the very least, we could say buyers still the aggressors. Now, we get a little consolidation up here. I've got green, I've got red. I get up to the top wick here, and now I start to see delta aggression coming down. 2 standard deviations, stacked imbalances. I got stacked imbalance buys and stacked imbalance sells on the reversal. So this becomes a reversal bar. So as we come down here, there's a little micro swing in there, and if you wanted the zigzag to show that to you, you could set it that way. Right? You could just lower the swing criteria to establish the trend. Where you would have gotten that little divergence here, I find the ATR is, I don't need to get every little swing identified here because visually I can just look at it here, see what's happening. Now I come down to this pivot. So here's the big swing. Here's the retrace. That looks like that looks like a perfect 38 here, right? If I oh, come here. It looks like that's a perfect 38. So would you have been considering a possible long here? Well, we're a little shy of the 38. It's a no interest short, pardon me, it's a no interest long here. I get green on the outline. And why is it a no interest long? Because this cumulative total of sell volume is less than this. Right? It's always comparing the prior swings. So this is a no interest long, and coming off of that, okay, buyers are starting to come in. I can see the volume reflected in the the bar outline. I push up. Now I've got 3 standard deviations on the delta, but I've also got a red outline here. So this is a bit of a mixed picture. Sellers are coming in here, but buyers are still the aggressors. Here's an attempt to break it. Goes up one last time. Now there, right, you'll, as I've shown you, you'll often find 3 standard deviations in the delta at the pivot. What do we get on the next tick high? Volume divergence, right? And not only do I get volume divergence, but I'm getting aggressive delta selling in that bar. Boom, and then 3 standard deviations. Now here I get a doji, right, with delta aggression on the buyers, or pardon me, on the sellers, but I've got a doji bar. So this, and that's right where I disconnected from the data feed as we went into this consolidation, which is just after noon. It's not terribly surprising. We would find that consolidation as we hit the noon hour. So that's going through swing by swing. I think, God, it's probably longer than it needed to be, but I'm giving you kind of clear insight into this. Now, let me pause here. I'll probably make this wrap this video and make the second one a part 2. Let's pause here, having worked through this, and let me take you inside the parameters, and let me kind of explain to you how to set this up and what your options are. So stand by.